When I talk to founders, the conversation always comes back to the same tension. They need capital, but every option on the table takes something from them. Equity takes ownership, debt takes flexibility, revenue financing takes growth. I've been working with startups for over 3 decades. I've watched thousands of founders navigate these trade-offs. What if there were a way to access capital without giving up any of those things? In this video, I want to go over exactly that. And it starts with an asset a lot of founders already hold, but have never thought of as a financing tool. Hi. I'm Dr. Hunter Allbright, Chief Revenue Officer at SALT, former banking executive and professor at the University of Colorado Boulder. Now, for nearly 30 years, I've worked at the intersection of credit, analytics, and emerging technology. From leading global portfolios in traditional finance to building Bitcoin-backed lending infrastructure today. This channel is about helping you think clearly in a noisy world, helping you understand Bitcoin through structure, risk, incentives, and long-term value. Let's start with the main problem. Because if you've ever raised money, you already know what it feels like. If you're building a startup today, capital strategy is just as important as product strategy. Founders traditionally have 3 options: to raise equity, to take on venture debt, or use revenue-based financing. Each come with their own trade-offs. Equity dilutes ownership. Debt adds fixed obligations and costs. Revenue financing can constrain growth. But there's a new capital tool emerging, and one that didn't exist a decade ago, using Bitcoin as collateral. Today, we're going to break down what that means, how it works, and when it may or may not make sense. This isn't about hype, it's about capital efficiency. Every founder faces the same tension. How do I access capital without giving up too much control? Equity financing is powerful, but expensive in the long run. You're selling future upside for present liquidity. Venture debt preserves equity, but introduces covenants, personal guarantees, dilution through warrants, and refinancing risk. And most early stage companies don't have meaningful hard assets to pledge. Their value is intellectual property, talent, growth potential, which lenders typically discount heavily. So founders often end up over-diluting early simply because they lack collateral. That's where Bitcoin changes the conversation. Bitcoin is a globally liquid, digitally native asset. Unlike startup equity, it can be priced 24/7, it settles globally, it has deep liquidity, and it doesn't depend on your company's performance. Now, for founders who hold Bitcoin personally or businesses that hold it on the balance sheet, it introduces a new financing pathway. Instead of selling equity, you can pledge Bitcoin as collateral to access cash. You retain ownership of the Bitcoin, you retain ownership of your company, and you unlock liquidity without a liquidity event. Now that's a structural shift. Founders that I've spoken to care about 2 things: control and upside. Selling equity early can be enormously expensive over time. What looks like a reasonable 15% dilution today may represent hundreds of millions in foregone value later. Using Bitcoin as collateral creates an alternative: access capital without selling ownership, without triggering a taxable sale. It turns passive asset into productive capital. That's capital efficiency. This strategy is not for every founder, but it does become compelling when you have high conviction in your company's growth. You believe your equity upside exceeds borrowing costs. You hold long-term conviction in Bitcoin, and you want to avoid premature dilution. It can also make sense in bridge scenarios, extending runway between raises, funding inventory or expansion, or seizing time-sensitive opportunities. So instead of negotiating from weakness, you can strengthen your balance sheet first. That changes your leverage, both strategically and psychologically. Using Bitcoin as collateral introduces specific risks. Let's face it, Bitcoin is volatile. If the price declines significantly, additional collateral may be required. And in severe cases, collateral can be liquidated. So this is not a free capital strategy. It requires conservative loan-to-value ratios, liquidity planning, volatility awareness, and clear downside scenarios. The mistake founders make is over-leveraging. The disciplined approach is treating Bitcoin-backed financing as a strategic tool, not as a maximum extraction event. Properly structured, it can complement equity, not replace it. Let's frame this correctly. Every form of capital has a cost. Equity cost equals dilution of future upside. Debt cost equals interest plus obligation. Bitcoin-backed capital equals interest plus collateral risk. So the key question is, which cost is most aligned with your long-term conviction? If you believe strongly in your company, protecting equity may matter most. If you believe strongly in Bitcoin, you may prefer not to sell it. Collateralized financing allows you to avoid forced trade-offs if structured prudently. Traditionally, startup capital stacks look like this: equity into venture debt into revenue. But increasingly, a modern capital stack may include equity, traditional debt, and Bitcoin-backed liquidity. Not as a replacement, but as additional layer. This gives founders flexibility, and flexibility is strategic power. Let's zoom out. Bitcoin is doing more than appreciating in price. It's becoming financial infrastructure. When a digitally native, globally liquid, bearer asset can be pledged programmatically for capital, that changes how startups think about balance sheets, treasury strategy, ownership, and dilution. So this is not just about borrowing. It's about optionality. And optionality is one of the most valuable assets a founder can have. Using Bitcoin as collateral is not about avoiding equity forever. It's about making deliberate decisions about when and how you dilute. It's about unlocking capital without forcing a permanent sale of assets you believe will appreciate. And it's about expanding the founder toolkit. The best founders think in terms of capital efficiency, not just capital access. In future episodes, we'll explore structuring conservative loan-to-value strategies, treasury frameworks for holding Bitcoin on the balance sheet, when to integrate Bitcoin into broader corporate liquidity planning. The financing landscape is evolving, and the founders who understand optionality will win.